If you're exposed to interest rate sensitive investments, interest rates and macroeconomic factors play a huge role in the result of your investment.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome back to another episode of Wealth Strategy Secrets of the Ultra Wealthy. Today, we're welcoming back a returning guest and trusted voice in the private equity and multifamily space, Omar Khan, founder of Boardwalk Wealth. Omar is a seasoned investor with over $800 million in transactions under his belt across acquisitions, developments, and restructurings. With deep roots in both institutional finance and a multi-generational entrepreneurial family, Omar brings a rare combination of global perspective, strategic insight, and battle-tested experience. In this episode, we go deep into the realities of today's commercial real estate market, why so many syndicators are being challenged, and how Omar is navigating this environment with disciplined underwriting and a niche development model that's outperforming in the Midwest. We cover the truth about the housing shortage myth, why liquidity should be as important as returns in your portfolio, the difference between projections, preferred returns, and guarantees, the 80-20 rule in private markets, how his firm re-engineered new development to deliver cash flow faster and reduce risk, and the number one mistake investors make when chasing IRR projections. Omar doesn't pull any punches. If you want unfiltered insight into what's really happening in private equity and how to allocate smartly in 2025, check out this episode. Omar, welcome to the show.
Thanks, Dave. How are you doing? Before the show, we were talking about your palace on the water in Sarasota. So please tell us, how far are we before we can see that?
Oh, no, we moved here a couple of years ago from Sarasota, and in fact, we met back when I lived in Virginia. Yeah. And it's been amazing I think this whole thing around geographical freedom, right, is just really empowering, post-pandemic, and that we were able to get rid of state taxes in winter all in one fell swoop. So when you kind of think about it right now, you really have a lot of opportunities in terms of where could you live in the world, today. So we wanted to be closer to family. My wife has family down here. We like the water. So, that's pretty neat. And yeah, we've been working on kind of a construction project. So it's interesting, but really excited to have you in today. Omar is a prior guest of the show as well, and wanted to bring him back and really talk some specifics about, the real estate market overall. Would like to talk about really, due diligence and what you're kind of seeing in the market. Of course, we're going to peg you with pulling out your crystal ball and giving us some predictions onto, your gut feel into some different things. But Omar is a very sophisticated investor, successful in, multifamily as well as, really private equity in the private equity market. So why don't we begin there, Omar? And, for folks who, haven't heard of you before, you tell us about your upbringing, which I know is really unique, and kind of how you got into private equity and commercial real estate in the beginning.
So look, in many ways, I feel like I'm very blessed. And not in many ways, I think in all ways, I feel I'm very blessed. I grew up in an entrepreneurial family. Depending on how you count it, it could be the third or fourth generation of entrepreneurs, because a lot of times by the second generation onwards, it's more management of the estate as well as, and less the proliferation of the estate. But anyways, that being said, my family is fairly financially sophisticated. So, when you grow up in that environment, it's not like they're trying to tell you, hey, go do this. It's more like, when you're around, look, I'll give you an example. Now I know more doctors because my wife's a doctor. So a lot of kids that grow up in a two-parent physician household are more attuned to that line of work, that profession. If you grow up in a two-engineer household or an engineer household, you just, process of osmosis says that you'll just pick up more things along the way. So it was more along that sort of way. And frankly, in high school, I very quickly realized I had absolutely no talent for the hard sciences like physics or chemistry or even biology. So it was conceptually, in my mind, an easier transition to go into accounting, economics, and finance. And that's what I did in my undergrad. I worked in an investment bank, did first portfolio management, then did my CFA, then worked in an investment bank, worked in oil and gas M&A. So it was a combination of, say, a good environment in this regard, financially sophisticated growing up, then being put into those professional settings, as you progress through the academic and professional ranks. And then finally, I was in Canada for all this time, for undergrad and then college, and then post college work experiences. But when I moved down to the US, I met my wife, moved down to the US. At that time, I believe it was right place, right time, right set of experiences. A lot of things have to go right for you. And that's basically how the journey started in a nutshell. We've done close to $800 million. We're sector specialists, all multifamily. We do acquisitions, developments, and restructurings. And along the way, the whole idea is that hopefully you're adding value along the way. And market cycles come, market cycles go. We're going through a bit of a negative time right now for everyone in the industry, not just say real estate, it's venture or private equity in general. So the whole idea when you're on the downtrend is to survive, and when you're on the uptrend is to prosper. Hopefully, that's the idea. But obviously, I'm sure we'll get into more of these things. But my story is more, I feel, a combination of good fortune, good mentorship, good environment, and a little bit of hard work along the way.
Yeah, key ingredients for sure. So why don't we unpack just private equity, your investment thesis, really kind of at that macro level, because, most of us, when we learned about investing, even doctors, lawyers, no matter what our trade is, right, we weren't really taught about investing. Right. And all that we understood about investing was really to invest in 401ks, right? Some type of IRA in stocks, bonds, mutual funds. So that was really the core option. Mm-hmm. So, how would you help people, think about adding private equity to their portfolio allocation, right? If they are, a traditional investor, right, with the majority of their assets in traditional, either, qualified or unqualified type plans, how would you suggest that people should start thinking about adding some mix of private equity assets?
First of all, unless you're like highly sophisticated or there's a specific state reason, I would tell people to keep their money, most of their money, in the public markets. So look, it hurts my business to tell you to not give me all of your money, because I'd love to take all of your money. But I do feel from an investor point of view, what kills a lot of people, look, unless you're a billionaire, then all bets are off, right? And then it doesn't really matter, I guess, right? But for the rest of us, liquidity oftentimes has to be as equally important as growth in assets. And you kind of have to balance both of these items, I feel. So I feel I would still suggest, if you're a doctor, physician, and let's assume you think, okay, I'm growing in my knowledge base, but I might not be there where I feel I should be. I would still suggest keeping the bulk of the portfolio in public securities, whether that's a 401k, whether you have a brokerage account, qualified plan, whatever it is. And then over a period of time, layer in basically tax efficient, tax advantage, or other alternative vehicle, just as a sprinkling on the top. So look, if you got, I don't know, 5, 10, $20 million, I personally, for me, I have to do it because I'm in the business. So I have to do co-investments. I have to put a lot of my net worth because I have to eat my own cooking. Right? Because it's very hard to tell somebody, hey, give me your money to put into my deal, but I'm not going to put any of my own money into the deal. So I'm in a very different position because of the nature of what my job and role is, right? But if you're not in my position, you're not a sponsor of these transactions, you have a day job, which is different than my day job, then depending, it could go anywhere from 10 to 30% of your entire portfolio. But again, then you're coming into other factors, like, for instance, what is the quality of your job? For instance, if you're a physician and you're on a salary and you're going to get paid the salary, whether the economy is good or bad, you have a very high quality of earnings versus, say, if you're in a cyclical industry, and let's assume you're in sales, because one year you could be up and the next year you could be down, right? Or you might be in a stage in life where your kids are going to private school, there's certain medical issues, God forbid, whatever it is, right? So I feel liquidity, you have to understand your liquidity needs, and then you have to marry them with your balance in your portfolio or growth in your portfolio. Private equity is a great complement, but I do feel a lot of the marketing around private equity is very disingenuous. A lot of the results that you see around that are proposed around private equity are results from, say, a completely different era. And now we're in a completely different era. But hopefully, when things change, things will improve. But right now, you have to be more defensive. And when you're allocating, I would not allocate more than 10, 20, maybe 30% at most. And I would pick between a couple of options. And because here's the deal, in the public markets, I'm just a believer in this. Everybody, as your mileage might vary, in the public markets, generating alpha is practically non-existent. Maybe there's like a couple of managers on the planet that are consistently generating alpha, which is above market returns. But in the private markets, the top 5 or 10% of the managers are taking 80 to 90% of the entire gains in that sector. So the power law is an easy way of saying that is an 80-20 rule, right? That really applies on steroids in private markets. So if you're in private markets, pick top tier managers, maybe allocate 10, 20, 30% of your portfolio, in my opinion, and sort of figure your way out, right? I mean, you'll figure it out once you give your own money. You'll sort of figure things out. That's the way I look at it. I think liquidity is very important and people don't pay enough attention to it.
Yeah, no, I think that's a really important point as well. And I like how you said that, right? The quality of your income, right? And so that's one of the key things we're helping clients with inside of our BFO is liquidity management, right? Is one of the top things. So looking at that quality and also creating really multiple streams of income, right? So you don't have actually a single point of failure, right? Whether it's one investment, one job, things like that. You have multiple streams of income that can help protect you in a downturn and just, keeping that cash flow coming in, which is really energy, right? That's energy for all the things that we want to do. Let's talk about due diligence. You've kind of pointed out that we are in a down cycle, especially commercial real estate. It's been, really, really challenging the past couple of years here. So have you changed anything in terms of how you're underwriting deals or looking at due diligence? What are some of the key lessons that you've actually learned from the past 2 years that you could help to pass on to listeners?
Look, I think here's the deal. Look, the bulk of the fundamentals, I don't think they change. I think the fundamentals stay the fundamental. Think about it this way. If you are playing basketball, it doesn't matter if you're in the championship game or in the regular season, there's certain fundamentals that are going to apply. You're going to have to play them. That's just the way things are, right? So the example I use is fundamentals have stayed the same. You don't necessarily waver on the fundamentals, but what you do over a period of time, especially when you're tested, is you keep refining on your processes. Like, hey, it's not always adding more steps. Sometimes it's also understanding that things that you were doing were redundant. So in this case, for instance, for a few years, you could literally underwrite everything with it without even underwriting. It's not even real underwriting. You could underwrite a 3% rent growth, at least in our, for instance, vertical. You didn't have to do a lot and everybody was making money. So now there is even a greater and more robust, basically, analysis around comps analysis, understanding demand and supply in the market. Again, these are all things that are fundamental and should have been done. But as humans, they weren't done because 10 or 12 years of a bull cycle means a lot of people get fat and happy and get lazy. So a lot of what I think are things people are learning are not necessarily learnings. They are just getting more attuned to it now that they have gone through a severe cycle. And to give you an example, it's very interesting for me to be on these panels, talk to people and say, oh, I will never take a floating rate loan again. And you're like, okay, that also doesn't make any sense, because what if you're in a declining interest rate environment, right? Taking a fixed rate loan makes absolutely no sense. Or for instance, people say, I am going to take I have literally heard this. I'm going to take a 7 or 10 year agency loan only. Great. Their business plan, but then you look at their business plan and their business plan says, I want to exit this deal between 3 and 5 years. Well, the problem there is you have an asset liability mismatch, because if you're going to exit something, say in 5 years, and you've got an agency loan at 10 years, unless you're a magician, your prepayment or defeasance or yield maintenance penalties that you have to pay to get out of that loan are going to just eat you up alive. So the point at the end of the day is you have to match your business plan to your sources of financing. You have to build a big liquidity buffer, basically. Again, we come to the same thing, right? Same as your portfolio, same as an alts manager managing this. And then you have to pick the right market. And you have to realize that there are times in the market where there is a flight to quality. So, for instance, in a downturn, usually there is a flight to quality, which means people want more quality assets. Therefore, they are going to overbid on those quality assets. And there are times in the cycle when quality doesn't matter. So you might as well go with the cheapest option. But picking those inflection points, I think you only learn with experience, as opposed to there is no textbook, because textbooks contain this stuff, but a lot of this becomes an art more than a science. So refinement of processes, understanding where you are in the cycle, and oftentimes you only know that post fact, and then not having asset liability mismatches, in a way, I think are the key takeaways.
Yeah, no, I think, points well taken. But I do think that, some of the top investors in the world are constantly learning and kind of refining that investment thesis. And one of them specifically, I mean, there's a lot of operators. I think, the audience needs to understand there's this basically an entire, I would call it like a stratification of the marketplace, right? Where you've got institutional, right, at the top level. And then you've got people at the bottom level, which are doing maybe friends and family, people with smaller assets, things like that, less experience, just kind of putting things together. And then you've got lots of things in between, right? Yeah. People that are growing and scaling. And so with that, many of those operators that you've seen deals kind of floating around have not even seen a cycle before, right? Or two. And to your point, everyone was making money in multifamily on the upside, for over a decade, right? Things were going really well, but now there's been a lot of, harsh truths, right, coming through with those debt that used floating rate debt, that didn't underrate, quality deals, maybe weren't aligned in the right markets. Anything else you can kind of point out as to some of the core fundamental challenges in multifamily today that were really a consequence of what happened over the prior couple of years?
Yeah, the core fundamental challenge was that people, I think, number one, two things, from a sponsor point of view and from an investor point of view. From a sponsor point of view, everybody keeps saying there is a shortage of housing. I don't think that's real. There is a shortage of housing at particular price points or particular points in the market. So, for instance, if you're on the top end of the market, there is no shortage. I mean, you can get the best product known to mankind if you're willing to pay the price for it. But let's assume you're in the middle income or slightly lower to middle income section of the. Yeah, there is a severe shortage. But you know what the problem there is? The problem there is the costs of construction and the cost of maintenance, as an example, are so high that you cannot effectively service that resident and make a profit along the way. So the shortage of housing that you read about, that you used to tout investing in this particular area, I think it masks a reality that is not existent. It depends where you are on the cycle. If you want to cater to the top end of the renters, as an example, and by the way, this applies in private equity, applies in VCs across the board. No shortage. As soon as you go down that spectrum, there is a huge shortage, but you do not have a product at a price point where you can effectively service that customer and make money for sponsors. Okay. Now, that being said, from an investor point of view, investors also have to realize that just because somebody's saying they have 20, 30, 25, 35% IRR, that doesn't mean anything. I mean, I could say I have a 2000% IRR. It's a target. And the other deal is, a lot of times investors assume a preferred return is some guarantee of a return, without necessarily realizing there is nobody on the planet, whether you are a Ken Griffin, a Howard Marks or some guy off the street that can effectively, consistently project, say, 3, 5 years down the line to the second decimal point. But investors typically confuse a projection, and these are, by the way, some really intelligent people, right? So they're not stupid people, right? They tend to assume returns with guarantees and preferred return for sure as some sort of a guarantee. None of these are guarantees. These are estimates. And by the way, the greatest investors like Warren Buffett, I don't even think he's touching a 20% IRR over the course of his life. Okay? So here's the problem. If a guy like Warren Buffett can't, we use a goat, basically. If he can't touch that level, how is it that the sponsor that you either met online or were introduced to is exceeding that on, saying that they're exceeding that on every single deal they put out there? So eventually, as an investor, you also have to do some due diligence or just put a framework around it to say, okay, how is this possible all the time? And look, you might have found the next greatest thing since sliced bread, but the chances of that are very low. So investors got to learn. Sponsors also have to learn. The housing shortage part, I do believe a lot of sponsors, it's not like they're misleading. They actually genuinely believe that. It's just that I don't think it's an accurate reflection of reality.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve. Yeah, and it's probably the same with businesses too, even if you're investing in venture, right? Everyone has a plan, right? Or like, Mike Tyson says, right? Everyone has a plan until you're punched in the nose. So, that plan looks enticing, and then people somehow psychologically feel like, hey, these are the numbers that we're going to be, exactly mirrored to. But there's all along the way, there's a lot of bumps in the road. So I think that's a great distinction that you make. And investors should always be wary, always do their due diligence, understand, sponsors' track records, understand the markets they're investing in, understand the asset class, to a really deep level that they feel comfortable with. And I would say on average, in the family office space, most family offices are very happy with a 14 to 16% IRR. And when it starts to go north of that, then they're actually asking even a lot more questions, right? Is that sustainable? Was that, just a great year, maybe that you had, or a great asset, right? That performed really well. What is the consistent kind of track record? Because consistency in this game is what really pays off big dividends. Now, Omar, I know that you're big into new development. So why don't we really unpack that a little bit? Because I think a lot of investors are very familiar with, multifamily or just real estate in general, right? Because we can all relate to it in terms of value add strategy, right? We're going to go in, fix up a place. We're going to increase, value through adding a pet park. We're going to, update all the appliances, make it modern, upcharge the rent. It all kind of makes sense, right? Why don't you tell us why you kind of prefer new development, and talk about some of the, pros and cons of new development?
Well, look, here's the deal. I think there's a time, like I told you, there's a time and place for everything. So a strategy that works in an up cycle might not work in a down cycle, as an example. So what happened with us, what our evolution was, that we were selling assets in the Southeast, Texas, Georgia, Florida. Some of these are vintage assets, and we were selling them for close to replacement cost. And as great as the operators we think we are, we've got benchmarks that attest to that fact. We also realized you have to be self-aware to realize that some of this is because the market is very frothy and it's very hot. So if some guy shows up with a bag of cash that's going to pay your 80s or 90s vintage asset for new construction price, Yeah, you're going to sell that asset to them all day, every day, and twice on Sundays. But that's not an accurate reflection just of your own abilities. It's a market helping you along the way. So knowing that, what we did was, okay, well, what is the biggest value add with the biggest moat around it, if within our sector at least? And the biggest value add with the biggest moat around it is always going to be development, because you can't just show up with a bag of cash and start going. You need to have specific knowledge and specific experience along various aspects of this business, number one. Number two, we were selling our assets in the Southeast, and again, did we accurately know what was going to happen with interest rates rising? No, but you have some feelings, but you don't accurately know. So for the assets that we were lucky enough to sell at great prices, return great returns to investors, we took a lot of that money and we funneled that into developments in the upper Midwest. I've got two very long-term partners. And the idea there was, hey, you've already made these gains, now protect these gains and push it into a product which is very desirable in that market, primarily because there's not a lot of hard money or institutional money at that time that was in the market. Now a lot of that is coming in because they've seen the safety and stability of the Midwest market versus this constant roller coaster in Texas, Florida, Georgia, and some of the Sunbelt states. Now, that being said, it also took us a few iterations to figure out the type of product we wanted to cater for, because earlier in the conversation, as you remember, I said, top end of the market, there is no problem. In fact, there is an oversupply issue. Like if you're in the top end of the renters, yeah, you got to pick up your litter. So we iterated a product over, and we put a lot of our own money into this. We iterated a product where we realized that a lot of the upper middle class residents, these are in great markets. They have great household incomes. I think our average resident is anywhere between $75,000 to $90,000 median income. These are great residents. They have the capacity to pay. They want a great place to live, but they're not going to pay $2,000 a month for a one bedroom. So we really iterated and we created a product over multiple iterations. We call it the reserve style model. It's a marketing moniker. And what we basically done is it's a 3-story garden style walk up, no elevator product. We provide only core amenities. So you're not going to see like a juice bar there, or you're not going to see underground parking. Because when we did the math on that, we quickly realized that these types of items were adding anything from 30 to 40% in terms of cost, but they weren't necessarily, the rent differential was maybe 7 or 12%. So you can see the math was working in our favor. The second thing there was, look, if you're building these buildings that are a monolith, you kind of have to deliver the whole building before you get a certificate of occupancy, right? Otherwise, you can't move people in. So you can't be done with, say, 3 floors out of 6 and move people into the first 3 floors. Typically, no municipality is going to allow you to do that, right? You kind of finish the whole thing, they do the inspection, then they give you that certificate. Well, the problem there is every developer on the planet is going to tell you they're going to do this in 18 months. It typically takes 20 to 22 months before you can move the first person in. And after that, you then have to start leasing, and your team is under stress all the time because now you have to lease the entire block of apartments in one go. So we iterated this product. What we realized was, look, instead of delivering all these buildings in one go, how about we have multiple buildings? So say 20, 15, 20, 25 units per building. And we deliver these buildings as they become available because each building gets its own occupancy certificate. So when we are able to do that, we deliver first units on these apartment buildings. These are phenomenal interiors and exteriors, great design. We really honed in very nicely on the design element of things. We're delivering first units between 8 to 10 months, typically 9 months, the entire project in 14 to 16 months, entire project. And we're 90 to 95% occupied between month 15 to 18. So by the time another competing product is actually just delivering, or rather they say they are going to deliver, by that time we're 90 to 95% occupied. So now, think about it this way. Even if we have the same loan, same exact term, same exact maturity date, we have a higher ability to push up our income with the ability to refinance or sell as the loan is maturing versus this regular guy over here. But that took a few iterations. There's fundamental issues there that we had to solve. And because we were able to do that, I have great partners, thankfully, we were able to really solve this problem, and we've been very successful at it. So, again, but you have to understand, this is meeting a moment in a need in time. So let's assume the market becomes crazy like 2020 or 2021. Then at that time, there might be a different play that has to be played. So this is a very good product for a moment in time, because investors are not just investors, residents, people that are actually going to rent out your buildings, they are tapped out. A decade plus of double digit rent growth means they can't afford paying more. So all you now have to do is focus on providing quality housing, but you have to cut costs on your buildings. And that's what we're doing. Our hard cost of construction is low to mid 130s to maybe early 140,000 a unit. A wrap or a podium product, it takes anywhere from 180 to 190,000 just as a hard cost of construction. So all that savings is basically savings that goes to the bottom line, because it's a dollar and cents game, right? It's not a tech play where you can become a billionaire overnight.
Yeah. No, I love the, creativity that you can have with real estate and breaking those down into smaller units rather than the whole thing and then waiting for the lease up and getting that in before you can actually start to drive revenue. That's a really strategic move. And, we've seen that on the development side where there's a certain niche, right? With an operator, a product, they have some kind of niche, some kind of competitive differentiation that usually kind of makes it shine above the rest. But talk to us about some of the risks, because again, I think there's definitely some inherent risks when you're investing in new development that, most people may not necessarily understand on the commercial real estate side.
Oh, 100%. As an example, for instance, I have never for the life of me understood how a lot of people that are not in construction, do not have a construction partner, basically hire third-party GCs. They do not have these teams built out, because here's the problem, guys. If your third-party GC has no incentive, no alignment of interest, God forbid, in the off chance that either that person leaves your project, you can't just put a new person in and just start like that. It doesn't work like that. So for our partnership, my partner Caleb has a multi-generational construction company. But how we've aligned interests there is that he signs on the recourse loans alongside us. So God forbid if things go sideways, he has a personal guarantee on this thing. Now, how does he get compensated? He gets a share of the general partnership. I might as well have partners where everybody is contributing and we split the pot, versus partners where one partner tries to get all the money and then everybody else feels aggrieved and then some things don't work out long term. Right? So having a shared aligned set of values is important. But look, in development, your biggest risk as an investor is, or just anyone, I guess, for that matter, is, will this project be delivered, and will it be delivered on time and on budget? And we've been able to do that, but I can tell you this, that I know of countless examples: Dallas, Phoenix, Tampa, Jacksonville. I know sponsors that were value add sponsors, did not have their own development team built in internally. And they were like, all right, let's try to do development because we can try to make more money. And they are 2, 3, 4 years into their projects, and the projects aren't even completed yet. So that's a huge risk. So you really need to understand and hone in on that, on the capabilities of the team and whether they have done this in the past or not. So finding the right partners is extremely important, because there is not a lot of value to a 20% completed development project. It's just a shell. It's not even a shell half the times.
Yeah, no, really, really good takeaway there for sure. And, let's kind of just transition back to a macro level and, your sense of the market. Again, we're not going to hold you to any of these predictions here, right? As no one can foresee really what's happening in the future. You turn on the news these days and there's some kind of major event. At least it seems like there's a major event really going on, on an hourly basis these days. But let's just kind of, bring it up to 30,000 foot level and just say, like, where, how are you feeling as an operator, a GP, someone who's, highly vested in this space? Where do you see, commercial real estate, multifamily in particular, kind of heading, within the next 3 years?
Well, I feel, number one, this is not just self-serving. I feel we're at the bottom of a cycle. So whenever it is the most painful to invest mentally, we know this, that is usually a time to go. Like, you should invest more, because it is actually Your peers are not investing. You can find a better deal just because there's less liquidity and fund flows in the market. So I feel we're at a cyclical bottom. It is a great time to invest, especially because interest rates seem to be cresting a little bit. I mean, there is some volatility. And I don't think interest rates are going to go back to the close to 0% interest rates that we had. But obviously, look, any amount that is materially, if your belief, as an example, is that if I look out 2 or 3 years and I believe there's a higher probability of interest rates being lower than where they are today, and assuming you have the right partner, you should be a net buyer of interest rate sensitive investments. These include real estate, these include private equity and other alts. If your belief is that interest rates, I believe, are going to be around roughly the same level, if not higher in 2 or 3 years, you should be a net seller of real estate and other interest rate sensitive investments. Now, we believe in the former. We believe all these years of interest rates being high has created a structural problem. Again, not a lot of supply is hitting the market once the current one is absorbed. So you're going to go back into a supply shortage issue, number one. Number two, if interest rates are going to be lower, that's our house view, in 2 or 3 times, higher probability of them being lower. It's not a certainty. Then if you acquire anything financed that works at today's interest rates, well, sure as hell, it's going to work at a lower interest rate. That's not rocket science. So that's the way we look at it. But again, you need to have some sort of a view. You can't say, I don't have a view and I'm just going to create value out of nowhere. Because yes, you can create operational value. But if you're exposed to interest rate sensitive investments, interest rates and macroeconomic factors play a huge role in the result of your investment.
And how would you be underwriting debt in this market right now?
Well, right now on our construction debt, it's all fixed rate debt, 4 to 5 year terms. We basically, as I told you, we're 9 months to first unit delivery, 14 to 16 months for the entire product to be delivered. So we feel we have anywhere from 2.5 to 3 terms of our rent roll. And our construction debt is usually about 150 bips to 200 bips higher than where agency or hard debt is. So there's a little bit of a margin built in there. Right? If it works at the construction debt level, it's going to pencil out at the agency and hard level. But that being said, we're also doing a lot of restructurings for a lot of syndicators that are in trouble. And that's a completely different ballgame, because then you really have to get into the loan docs, negotiate with lenders. There's a whole bunch of steps there. But the way I look at it is, depending on what you're doing, for our developments, it's all fixed rate exposure right now. But look, 2 or 3 years from now, it might not be fixed rate exposure. We have to go with the times. There is no like absolutes, basically.
Yeah. Any other things that investors should be kind of watching or paying attention to in this market here, 2025?
I think, look, if you're investing with people, the biggest issue is doing due diligence on the people, their abilities, the composition of their team. If somebody's a 1-man or 2-man people operation, it's probably not really going to work out, right? It's nothing to do with their abilities. It has everything to do with the fact that you need to have teams that help you come this whole idea of a lone sponsor or investor doing everything doesn't really work out. There's a key man risk there involved as well. So looking at the composition of the teams, their tenure, their capabilities and abilities, looking at the whole organization, looking at the track record, but also then having a house view that you could have the best team on the planet, but if it's in a section of the market you don't want to invest in, then it doesn't really matter. So you need to have some sort of a view. You need to be some sort aware or make yourself aware. But at the end of the day, a lot of this boils down to the people.
Yeah. Omar, if you could give just one piece of advice to the audience about how they could accelerate their own wealth trajectory, what would it be?
Yeah, my one piece of advice would be to basically it depends where you are on the wealth cycle. So if, for instance, if you're starting out, it's a very different ballgame to say you're 20 years into this. So if you're, say, 20 years into this, you're a high-income earner, I don't know, you make 500,000, a million, a little bit more than that, right? You need to start paying attention to tax efficiency as much as investment gains. Because as an example, if you're in the great state of California and you're taxed 50%, well, no investment that I know of is consistently going to throw off 50% year on year. So you're better off, say, focusing on a tax efficiency and structuring versus necessarily finding the next greatest investment, as an example. I mean, you should try to do that, but really, if you have to spend a finite amount of time, focus on tax efficiency, tax structuring, all of that sort of stuff. That's going to generate the most after-tax dollars to your bottom line. But look, if you're at the start of your career, I wouldn't worry about taxes too much. I'd focus more on upskilling. But at the end of the day, guys, just remember, nobody saved their way to prosperity. You have to invest. You have to take your lumps. That's been the story throughout the ages, basically. You have to aggressively invest and live below your means.
Sage advice. Omar, really appreciate all the wisdom and your time today. If people would like to reach out and connect with you, what's the best place they can find you?
Look, you can join my mailing list by going to boardwalkwealth.com. The form is right there on the homepage. Again, that's at boardwalkwealth.com.
Awesome. Thanks again. Really appreciate it, Omar.
Thank you, Dave. Back to me.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.